If you're going through a Florida divorce, the QDRO tax trap costs divorcing women tens of thousands of dollars in penalties they never see coming, and most find out only after the money has already vanished from their accounts. QDRO stands for Qualified Domestic Relations Order. And if you are a woman in Florida going through a divorce or even considering one, mishandling this single document can wipe out a massive chunk of your retirement settlement overnight in taxes and penalty. What makes this particular trap so devastating is the size of what's at stake. Retirement benefits rank as the largest marital asset after the home in most marriages. And according to the Pension Rights Center, roughly 50% of US divorces overlook retirement benefits entirely. That gap hits women the hardest. 1 in 2 divorces, and the retirement money just slips through the cracks. Everything I'm covering today comes from IRS rules, Department of Labor guidance, and federal law under ERISA. We're walking through what a QDRO actually is, how the tax trap triggers, which specific mistakes cause it, and the exact steps you need to take to protect your settlement. None of this is opinion, and it starts with a problem most women don't even realize they're carrying into the process. The retirement savings gap between men and women in this country is staggering, and it shapes everything about how divorce plays out financially. According to the US Treasury, women workers hold a median retirement balance of $56,000, while men sit at $92,000. That's a 39% gap before anyone even files paperwork. Bankrate's numbers paint an even bleaker picture. 28% of women contribute nothing to retirement at all, compared to 18% of men, and 62% of women report feeling behind on their savings. Both Morgan Stanley and the Institute for Women's Policy Research have confirmed that women's retirement balances fall roughly 30 to 39% below men's across the board. This issue becomes even more pronounced in great divorce after age 50, where women have fewer working years to rebuild their retirement savings after the settlement. The QDRO conversation matters more when you understand that context. When your husband built a 401k during your marriage, perhaps while you raised children, or managed the household, or worked part-time, or earned less, that retirement account doesn't belong solely to him. Florida Statute 61.076 mandates that all vested and non-vested benefits, rights, and funds accrued during the marriage in retirement accounts get addressed in contested divorces. Florida operates as an equitable distribution state, which means marital assets are divided fairly, though not necessarily 50-50. Your share of that 401k could represent the single largest financial asset you walk away with. For Florida state employees, the Florida retirement system voluntarily accepts QDROs, but has specific submission requirements that differ from private sector plans. Additionally, if your spouse serves in the military, common here in Florida, military pensions require a military pension division order, not a traditional QDRO. And that's exactly where the QDRO enters the picture. A qualified domestic relations order is a court-approved legal order that splits qualified retirement plans between divorcing spouses, covering 401k plans, 403b plans, pensions, and profit-sharing plans. Federal law governs the entire process under ERISA, the Employee Retirement Income Security Act of 1974, with the specific rules laid out in Internal Revenue Code Section 414P. But here's the thing most people miss entirely. Your divorce decree can say whatever a judge wants it to say. A court can award you 50% of your ex-husband's 401k in bold letters on official paper, and it won't move a single dollar. The plan administrator at his employer, whether that's Fidelity or Vanguard or anyone else managing the account, doesn't answer to your Florida divorce court. They answer to federal ERISA law. And federal ERISA law demands a separate QDRO before any transfer happens. The QDRO itself names you as the alternate payee, spells out the exact dollar amount or percentage you're entitled to, and gets submitted directly to the plan administrator. That administrator then reviews the order over a period that typically runs 30 to 90 or more days to confirm everything meets federal qualification requirements. Without this document filed and approved, your share of that retirement account exists only on paper. The money never actually reaches you, which is where everything starts to fall apart. Let me walk through the math on a real scenario so the damage becomes concrete. Say you're 45 years old and a court awards you 50% of your ex-husband's $400,000 401k. Your share comes to $200,000. Under the first scenario, everything goes right. A proper QDRO transfers your $200,000 directly from his 401k into your own IRA. The transfer stays tax deferred, meaning no income tax hits and no penalties apply. That money grows in your account until retirement. This is the correct outcome. Under the second scenario, the QDRO never gets filed. Your attorney included your share in the divorce decree, but nobody drafted the separate QDRO or submitted it to the plan administrator. The money never moves, and your ex-husband withdraws the full balance himself. The IRS collects approximately $44,000 in federal income tax at the 22% bracket, plus a $20,000 early withdrawal penalty because he's under 59 and a half. $64,000 disappears to the government. Your share from the plan comes to zero, and you'd have to go back to court to try recovering anything, assuming there's anything left to recover. The third scenario is the subtle one that catches even women who did get a QDRO. A valid order transfers $100,000 to you, but instead of rolling that money into your own IRA, you take the cash. Maybe debt needs paying, maybe legal fees piled up, maybe you need a car. One piece of good news applies here, and it's specific to QDROs only. Under IRS Code Section 72 T2A, distributions received through a QDRO are exempt from the 10% early withdrawal penalty. That exception does not apply to IRA withdrawals, only to QDRO transfers. Federal income tax still lands on the full amount though. At the 22% bracket, that's $22,000 straight to the IRS, which wipes out over a fifth of your settlement in one move. And you've also just emptied what might be your only retirement account. One Florida-specific detail works in your favor here. Florida charges no state income tax. So unlike women in California or New York, you won't face a state tax bill stacked on top of the federal one. Federal income tax alone, though, can devastate a settlement when it catches you off guard. Now that the math is clear, 5 specific mistakes trigger this trap, and any single one of them can cost you your retirement. The first and most common mistake is never filing the QDRO at all. The divorce finalizes, the decree awards you half the 401k, and everyone assumes the job is done. Nobody drafts a separate QDRO, nobody submits anything to the plan administrator, and the money stays exactly where it sits. Your ex-spouse can legally withdraw from their own 401k at any time with nothing stopping them, and by the time you discover the QDRO was never filed, the account could already be drained. Filing a defective QDRO ranks as the second most costly error. Federal requirements demand specific elements in the order, including full legal names, addresses, social security numbers, the exact dollar amount or percentage, the payment period, and the plan name. A missing or incorrect element triggers a rejection from the plan administrator, which forces you to start over while burning time and money with the account still sitting exposed. Confusing an IRA with a 401k is the third mistake. And it's one attorneys themselves sometimes make. IRAs don't require a QDRO at all because they're divided through the divorce decree under IRS Code Section 408D6. A 401k requires a QDRO under IRAs, a full stop. Treating a 401k like an IRA means just putting it in the decree and moving on, and that guarantees you will not receive your share. Different accounts follow completely different federal rules. The fourth mistake involves skipping pre-approval from the plan administrator. Best practice calls for sending a draft QDRO to the plan administrator before submitting the order to the court, and this step catches problems before the order becomes final rather than after. Major plan administrators like Fidelity maintain dedicated QDRO processing departments for exactly this purpose. Skipping pre-approval is how women end up holding a rejected order with months of delays ahead of them. Delay itself rounds out the list as the fifth mistake. No federal statute of limitations exists for filing a QDRO after divorce, and courts have upheld QDROs filed more than 20 years after the marriage ended. But the practical dangers of waiting are severe. Plan records can disappear after roughly 7 years. Some plan administrators enforce their own internal deadline, and every single day without an approved QDRO in place is a day your ex-spouse can take loans against the account or pull funds out entirely. A legal right to money that no longer exists doesn't protect anyone. For women whose ex-husband's pension plan was terminated by the employer, the Pension Benefit Guaranty Corporation has separate QDRO procedures that must be followed. The correct process follows a clear timeline when handled properly. Drafting a QDRO typically takes 2 business days to 2 weeks. Court approval ranges from days to months depending on the jurisdiction, and plan administrator review runs 30 to 90 or more days after submission. The full process from start to finish takes anywhere from 2 to 12 months on average. Attorney fees for drafting a QDRO land between $1,000 and $5,000 or more, depending on complexity and location. That price tag stings when divorce bills are already piling up, but the alternative tells the real story. On a $200,000 401k share, the tax penalty for mishandling the transfer can blow past $60,000. The QDRO fee isn't an optional line item because it's the document that turns your settlement from words on paper into actual money in your account. The Department of Labor publishes a free guide called QDROs, the Division of Retirement Benefits through Qualified Domestic Relations Orders, on dole.gov. Read it before your next attorney meeting and bring it with you. The Pension Rights Center operates something called the Women and Retirement at Divorce Initiative, and their findings should alarm every woman navigating this process. Their research shows that very few people obtain QDROs relative to the number of divorces filed each year. The barriers they've identified include non-disclosure of retirement assets by the other spouse, attorneys who lack QDRO-specific knowledge, and plan administrators rejecting orders that don't meet requirements. Low-income women and women representing themselves in court face the worst odds of navigating the QDRO process successfully, which means the people who need this protection most are the least likely to get it. That 50% figure from the Pension Rights Center deserves a note of transparency. The organization does advocacy work, and the full methodology behind that number isn't detailed in their public reports. But even cutting that figure in half, even at 25%, means 1 in 4 divorcing women potentially abandon their largest financial asset over a paperwork gap. 6 concrete steps will protect your settlement if you act on them. First, identify every qualified retirement plan your spouse holds, and that means 401ks, 403bs, pensions, and profit-sharing plans specifically. IRAs follow a different process through the divorce decree and don't require a QDRO. Second, ask your attorney directly whether they have drafted QDROs before. The QDRO process is a specific skill set that sits outside general family law, and a hesitant answer means you need a specialist. Third, contact the plan administrator early to get their exact QDRO submission requirements and ask them to pre-approve a draft before you take it to court. Fourth, begin drafting the QDRO during the divorce proceedings rather than waiting until after everything finalizes, so the order is ready to file immediately. Fifth, roll your share into your own IRA when the transfer comes through, and do not take cash under any circumstances. The moment you accept a direct distribution instead of a rollover, federal income tax hits the full amount, and at the 22% bracket or higher, that bite takes over a fifth of your settlement, even with the QDRO's penalty exemption in place. Sixth, file without delay, because every day without an approved QDRO is a day your settlement sits unprotected. Everything covered in this video comes down to one reality. The QDRO tax trap is not some buried loophole or obscure technicality. It's a straightforward federal requirement that most people simply never learn about until the damage is done. The retirement gender gap already means women enter divorce, carrying 30 to 39% less in savings than men. Florida's equitable distribution laws guarantee your right to a fair share of marital retirement assets built during the marriage. But that right only converts into real money when a properly drafted QDRO lands with the plan administrator and your funds roll into your own account. One document, filed correctly, filed on time. That separates keeping your full settlement from handing tens of thousands of dollars to the IRS for no reason. If you're going through a divorce in Florida, or anywhere else for that matter, do not leave this to chance. This is your retirement, and it deserves protection. Share this video with someone who needs to hear it before they make a mistake they can't undo, and I'll see you in the next one.